Today is June 3rd, and I'll be doing a comprehensive review of the stock indexes today. I'm going to start with a longer term pattern and then work down into the shorter term pattern, just to give an overall view of what I see here and what I think will be the most high probability scenarios for the upcoming few weeks and longer term as well. This first chart is a monthly chart of the S&P 500. Mainly what I want to show here is the potential long-term pattern with some projections on it. So pay attention to the red labels here. Pay attention to a few of these projection lines. So first off of the 2000 highs, what I believe may be occurring here is an expanding triangle in Elliott wave terms. We had an A wave. The B wave is larger than the A wave. Actually made a slight new high there. On percentage terms, this made about a 100% advance. And then the C wave was larger than that A wave. Then we have a D wave. This was actually larger than the B wave, and in percentage terms it was over 100%. So we're seeing each successive wave on a percentage basis being larger than the prior wave. In this case, the E wave would have to be longer than the C wave at a bare minimum. So if we take the length of the C wave, project it down from the high of the B wave, that would put us somewhere 600 or below. Also, if you look at the trend connection point between A and C, very often expanding triangle will at least come down to that trend line, oftentimes overshoot it a bit before reversing. This projection line here is 161.8% of the A wave decline. So this decline was almost exactly 50%. So the market was cut in half there. So 1.6 times 50 would be approximately 80. So you'd be looking at an 80% decline off of the highs of this year to the eventual low, which is a very big decline down into the 200s, mid 200s on the S&P 500. So that seems very dramatic, very out there, but that's certainly a possible target there. The other thing I have shown here, these dotted pink lines are 127.2 and 161.8 external retracement of this D wave. So if we take from here to here, back to this level would be 100% retracement. Down to here would be 127.2% retracement. This would be 161.8. That is the most common zone that I find as being a bottom reversal zone on the extension of the preceding wave. So we would expect that to bottom to potentially occur somewhere between this level and this level. So those give us some rough targets as certainly all breaking the 2009 lows and then bottoming somewhere in this area. So on a longer term perspective, looking at a couple years, we may see some very, very dramatic declines in the market. I do think that is the likely scenario given a number of factors here. What I also want to point out on a technical analysis level is here's the stochastics on the monthly chart. And stochastics has come out of overbought territory and then has now made a bearish cross as of the month of May, which just ended. And then immediately in June we saw a lower low, so we have a trailing one bar low confirmation of that, confirming a sell signal in stochastics. Now some of these other declines only lasted a month or two or three, but if the pattern is complete here, which it looks to me that it's possible that it is for the D wave, having a successively contracting pattern here, that we may see a wave corresponding to the waves A and C here. This was a 27-month decline. Down here, this was a 17-month decline, or excuse me, this was 29-month decline, 17-month decline here. So we'd be looking at potentially a two-year decline or so on average, looking back at those prior patterns. So on a long-term basis, that gives us some projections here. In the prior two bear markets in 2000 and 2000, off the 2007 highs, we did see the monthly stochastics get down basically to oversold before bottoming, and then once it got oversold and crossed back above the 50 line. That was a good indication that the bear market was complete. So if we do see this continue down here and crossing this 50 line, that would be what to look for. Wait for it to get oversold, wait to have a cross back up above that line as confirmation of a bottom. This is a weekly chart of the S&P 500 with a stochastic study underneath and Bollinger Bands up above here. And what this is showing is as of this past week, the stochastics is now oversold on the weekly time frame. And additionally, if you zoom in on the Bollinger Bands, the market closed just slightly below the lower Bollinger Band here. So on a relative basis, the market is oversold here. And we may expect a rebound at this point. Next week should be very telling as far as that goes. So on a momentum basis, we have oversold momentum. We have the market below the lower Bollinger Band, though the bands are relatively tight. Looking back at prior times coming off a high where the market hit the lower Bollinger Band initially here, had a sharp rebound initially here, had a sharp rebound. You could go back even off the 2007 highs when it touched down here, had a sharp rebound. So the tendency is after a new trend high, the first touch of the lower Bollinger Bands will lead to a rebound. Now, some of these past ones have been 2 to 3 weeks or so, 2 to 4 weeks before topping and then leading to new lows. So we may expect that here, couple week to 1 month rebound in stocks, potentially followed by new corrective lows, maybe dramatically so at that point in time. This is a daily chart of the S&P 500 that shows the 50-day moving average has turned down. The market's well below that. This is the 200-day moving average, and on Friday the market both touched and closed below the 200-day average. That is very often a relative inflection point in the markets. You see back here the market tagged that several times, found support, tagged it here a couple of times before falling through dramatically. And then on the rebound, the market repeatedly found resistance at the 200-day average before finally breaking through. So on this initial test, my expectation would be it's unlikely for the market to just barrel through the 200-day moving average. We may undercut it, wash out some stops, cause some indication of a trend change based on that level, but then see a nice sharp rebound after that. Maybe back towards the 50-day moving average there. So that'd be something to look for here. Below here we see an ADX study, so showing trending activity. It's starting to get extended. It's at a 34 level, on a textbook level 40, which is this pink line here. 40 is the extended trend level on a textbook analysis, so we're getting close to an extended downtrend here. So on these bases we may expect a rebound relatively soon in the stock indexes. This is a daily chart of the Russell 2000 index, and what I have is some conventional Elliott wave labeling on here, looking at the move down off of 2011 highs as possibly being a 1, 2, 3, 4, 5 type of move. Though I don't tend to use that analysis as my primary analysis, I do keep a couple of different wave labeling type of scenarios on the charts here. So if you see that as I'm clicking through these charts, just kind of ignore that. It's really not important. I'll point out what I think is important. What I see here is on the stochastics on the daily chart. At the low on May 18th, stochastics was very oversold. We had a brief rebound and now a break to new lows, but the stochastics is at a much higher low. So this is potentially setting up a very powerful bullish divergence at this new low. Again, suggesting if we do see the market rebound and the stochastics then makes a bullish cross here, that we could see a sharp rebound back into at least up into the maybe 61.8% retracement levels of this decline. If you look at this decline in conventional Elliott wave terms, you could conceive this as possibly a wave 1 and a wave 2, a wave 3 down, and then a wave 4 up, and a wave 5 possibly unfolding here. Again, I've put the 127.2 and 161.8% retracement of this wave 4. That's often the high probability reversal zone for a wave 5, and so we're already touching that zone as of Friday. So we may see, with Wednesday, Thursday, and Friday being down in the markets, and a lot of people are familiar with the concept of a turnaround Tuesday, we may see if we see some weakness early this coming week, Monday or Tuesday, as a sweet spot, either Monday or Tuesday, for the time frame of a potential reversal back higher in the markets. So that's what I would be looking for this upcoming week. Is most likely, I think, taking everything together, is expect a rebound here next week and possibly into the following few weeks after that. This is a daily chart of the Nasdaq with a few lines here. This line is a support line for a something akin to a head and shoulders type of pattern here, with a projection of the conventional measuring down, down from the neckline there. So we're basically close to meeting that conventional target for a head and shoulders chart pattern. Now that's not a real pure head and shoulders chart pattern. I just have that there as a guideline. What I think is significant here is the RSI study below here. So this is a daily RSI study. Very oversold at the May 18th low, a brief rebound, and now we have a very strong bullish divergence here. Now, until the market reverses higher and closes back above this low, we don't have good confirmation that bullish reversal is happening. We could, for all we know, this RSI could come down and make a lower low. But if we do see some strength early next week, close back above those lows, that will be good confirmation of a reversal that should take us at a minimum above this high here. If you look at the 61.8% retracement of this entire move down, that would maybe put us back somewhere up in these levels here. So that would be what I'm looking for on the Nasdaq. This is a chart of SPY, so the S&P 500 ETF SPY, and what I want to point out here is really the Bollinger Bands. I had noted the potential flag pattern on the blog recently this past week, and that's pretty short time frame for a flag pattern. A lot of times you want to see flag pattern go 2 or 3 weeks, so it may not be a great flag pattern. If it is a flag pattern, then we should take the pull of the flag, project that down from the breakout point, and see the market somewhere down around 1200 or $1.20 on or 120 on SPY. Now, given the other technical analysis, I don't know that will actually occur in this case. I think it's more likely we do see a rebound from this point. However, that flag pattern is a reasonable chart pattern. What I want to point out is the Bollinger Bands. What is typical after a very sharp decline is we saw the Bollinger Bands expanding as the market declined, and then the top band started to turn down here, and as of last week, the bottom band actually started to turn up. In most spike type of bottoms, you will see the market hold above that as the market consolidates for several weeks. And in this case, what we now saw is after just a brief rally attempt, the market broke down to new lows. The top band is now pointing sharply down, and the bottom band then expanded down as well. So now we have the bands channeling in a downward trend. That is usually conducive to a stable downward price trend. And so on that basis, we may be set for more of a steady downtrend here. But looking at the technical analysis purely, we're seeing divergences show up across the board on a lot of different levels here. I take that as being the primary thing of importance here. So I would expect a rebound given that. This is an hourly chart of the SPY ETF. So again, here's the 127 and 160.8. 161.8% retracement, external retracement of this move here. So we're just touching that level. This would be the sweet spot for a reversal here this coming week, is in between 127 and the 128 level. This is a MACD showing MACD is oversold, but we do have some bullish divergence relative to the May 18th low here. If we can get a low early next week and then a bullish cross on this MACD at a higher level than this MACD here, that would be a pretty good signal where you could go long with a stop below whatever low occurs early in the week and have a target definitely above this level here. Probably this unfilled gap down level here would also be a reasonable target, but we have an unfilled gap down there, there, and there, so those would be 3 potential targets where you could use to, if you take a long trade, to sell or take partial profits at those levels. This chart shows the McClellan Oscillator, which is a moving average of breadth, or advancing and declining issues in the market. And I believe I had pointed out recently on the blog that as of a couple weeks ago there on May 18th, we saw this very low reading in the McClellan Oscillator, almost as low as the dramatic decline into August of last year. And but I pointed out that usually those extreme lows are not the ultimate bottom. Usually there's going to be a rebound in the market and then a move to new price lows, but you'll see a divergence in breadth there. And that's what we saw into the kind of crash low in August 8th last year. The market rebounded sharply and then retested that low later in August and continued to rebound into early September. And then when the market even came down and finally broke that August low, the first week of October, you had a much higher McClellan Oscillator, setting the stage for a really strong advance. So we're seeing that here now. We've had a rebound in the market. We've just pushed to new lows, yet the breadth is at a much higher low. So given that, we may expect again at least a 1 to 4 week rally in stocks there. So adding that to the other evidence there, I think the stage is set for a rebound here. I'll also click over to a chart of the put-call ratio, and the put-call ratio is showing the same thing. We had a pretty big spike in the put-call ratio into that May 18th low. We saw a couple of days where it was 0.99 or just below 1, which is a very extreme reading in the equity put-call ratio. I did note that we should expect a rebound at that point in time. We did see a brief attempt there. Again, with the market pushing to new lows, the put-call ratio only hit 0.81 on Friday. Volume was also relatively low Friday compared to Thursday, so that's also another divergence of sorts there. So we're seeing several divergences show up on the daily time frame at this point, indicating a rally attempt should be coming. We're really relatively early in the trend down on weekly and monthly time frames. So that's the overall take that I'm leaving for the stock market at this point in time. So what to look for here is a rebound, a overbought stochastics on the daily chart, and then look to sell or short the market or select stocks at that point in time. So if we use the Russell 2000 here as an example, let's say we get a reversal Monday or Tuesday, and then we see the stochastics cross up and then move up into overbought territory as we get in a couple weeks down the road, maybe into middle or late June. We see the market get overbought here and then start to roll down. You can start to take those sell signal thens and look for stocks that are showing nice patterns, whatever trading method to short, or look to take signals to short the market in general there. So that's all for this update on the stock market. I plan on making another video showing some of the world markets for those interested in some of the bigger picture patterns on those markets. Have a great weekend.